Hello, and welcome to this Peak Prosperity podcast. I'm Adam Taggart, co-founder of peakprosperity.com. Today is March 11th, 2020, and we'll be talking about the drastic action currently taking place in the stock and bond markets. We have a truly amazing panel of experts assembled to make sense for you of what's going on. John Hussman, Steen Jakobsen, and Chris Martenson. But before I bring them on, here's the context for today's discussion. For a long while now, Peak Prosperity, as well as the experts who will be joining us for this webinar today, have been raising a loud warning that the decade-long bull market had metastasized into a massive financial bubble, as central banks around the world had printed $15 trillion in the years following the Great Recession, with that massive flood of liquidity distorting asset prices far beyond what their fundamentals justified. We've often referred to this as the everything bubble, as it has deformed prices in nearly every asset class, from stocks to bonds to real estate to collectibles to most goods and services, you name it. Well, as they say, every bubble was in search of a pin, and it appears the everything bubble has finally found its Waterloo in the coronavirus. The unfolding pandemic has already infected over 100,000 people and killed thousands, seriously disrupting global supply chains and decreasing demand for global trade as millions of consumers hunker down around the world. The impact on markets has been sharp and severe. Since their all-time highs just back in mid-February, stocks are now down over 20%, which now officially means they are in a bear market. Bond yields have cratered to staggering lows, and demand for oil, arguably the world's most important commodity, has fallen nearly 30% in just the past few days. To put it another way, the 10-year bull market just died of coronavirus. To help us make sense of what's happening now, what's likely to happen next for the global economy and financial markets, and more important, what actions concerned investors should be taking now, we are extremely fortunate to be able to tap the impressive brain trust of today's expert speakers. Now, we initially planned to film this as a panel amongst all three speakers, but today's volatile market action required that we record two separate conversations. So we've broken this into two videos. This video, the first one, is going to be the discussion with John Hussman and Chris Martenson. And then the next video is going to be Chris Martenson, John, and myself as well. So without further ado, let me introduce John Hussman. John is an economist and asset manager who successfully anticipated both the dot-com and 2008 market corrections. John also runs several foundations dedicated to public health, research, and support for vulnerable populations. He also has a number of published research papers in the fields of statistical genetics and molecular disease pathways. Pretty impressive resume, John. Thanks so much for joining us today.
Pleasure.
Perfect. And last but not least, we have Chris Martenson, my fellow co-founder of peakprosperity.com and author of the Crash Course video series. He called the 2008 financial crisis with spooky accuracy. Chris also has a PhD from Duke University's Department of Pathology and has been very busy of late, producing a daily video update on the developing coronavirus pandemic, each update of which is now watched by over 500,000 people. Chris, great to have you on.
Thanks. It's good to be here.
Good, good. I had you go last because somebody had to follow John Hussman's bio. Man, that's a tough one to follow.
I know. It is. It really is. And so pleased to have this particular crew. Steen, John, welcome, and thanks for being here. Because this is a really fast-moving situation, and it's going to take an incredible brain trust to even begin to make sense of the fast-moving situation that we're all facing right now.
Great. Well, gentlemen, thanks so much for joining us on what continues to be a very volatile week in the markets. I know you're all very busy. We really appreciate you taking the time to talk with us. Chris, let's start with you because I'd like to provide some context on this pin that's popping the financial bubble, the coronavirus. Why is this virus such a bigger threat than those we've seen in our lifetimes to date?
Well, it's a really good question. I know that we've been facing a lot of resistance, I should say, from official authorities and people who wanted to think it was just like the flu and things like that. And of course, it's nothing like the flu. And the basic elements are this, and I won't go into everything we know about this. Obviously, that's a whole separate hour-long video, many of which I've already produced. But here are the basics. The one thing about this coronavirus is the novel in its name. That means humans haven't seen it before. Before it came out and struck the first people in China, nobody on Earth had seen it. So there were zero antibodies circulating. There was no herd immunity. which is a necessary condition for having any sort of a fire break to slow down the spread of any particular viral disease. And the second thing about this is that it has an incredibly easy transmissivity, and that's measured in something called an R0 technical term, which answers this question. Hey, if I have it, how many people on average would I give it to during the course of my disease? And seasonal flu has an R0 of 1.28. It's fairly low, but still, the flu gets around, and we all know that. This thing has an R0 somewhere between 4 and 7, which means that by the time if I'd had the flu and I'd given it to 100 people, this virus I would have given to 1 million people once you track it out if it has an R0 up near 7. So it spreads very quickly. And then the third and final thing, which is the part that really brings us to the heart of today's webinar here, is the fact that it has about a 15, maybe 20% serious complication rate, serious defined as you have to go to the hospital. And of that, call it 20% or 15%, 5% are ending up in ICU beds. When you run the math, you find out that with a population with no herd immunity, a very high transmissivity, meaning it bursts very rapidly through the population, and you combine it with the hospital system's capacity to handle people, how many ICU beds do they have? This is very bad math. And so that's the chief concern about this, is that all of a sudden, like we're seeing in Italy, same thing we saw in Wuhan, is an overwhelmed hospital system. That spooks people. It spooks me. That's a very normal adjustment reaction process people should go through. And because of that, all of a sudden, consumer behaviors and people's behaviors change on a dime. So this is going to be, obviously extinction level event potentially for like airline industries, which are super capitalized, a very heavy capital industry that depends a lot on managing their flows of traffic against all of their capital investments. So this is an event that's going to really shake all of our foundations because it's so disruptive to daily life. I live in a small town, about 1,300 people. Was at an emergency meeting with the town officials last night. They were asking me, what I knew. They were wrestling with what they knew, and immediately they just canceled all sorts of public events. And they took the CDC guidelines of no more than 100 people and just ripped those up and said we shouldn't be having any gatherings. That sort of behavior set is going to change everything in my small town, from food catering to gasoline consumption to who knows what else. And so that's why it's a fast-moving situation, and we've got to do everything we can to keep up with it.
Very important points, Chris. John, given your research background in public health, what would you add to what Chris has said?
I want to get this really up front. The goal here is not to scare, but to prepare. All right. If you're scared about this, you want to step back a little bit, because the mortality rate 97-ish%, 90, and we can argue about exactly what that number is, but the vast majority of people who get this virus are going to be fine. They're going to be fine on the other side, right? So this is not something that we want people to be scared about. At the same time, to say that this is just the flu, or to quote flu statistics, when an average year in the U.S. has 30 million cases of flu, with an average mortality of about 38,000, and we know that the average mortality of this is higher. You don't want to dismiss this as something that the nation doesn't have to worry about, or that we shouldn't be prepared for, because we've still got exponential growth to this thing. We do not have logistic growth. It is not calmed down. We've got cases growing in the U.S. And elsewhere that are at about a 20% rate daily. We've got mortality growing at about a 27% rate daily, which suggests that we're not actually catching all the cases. And so this is something that you shouldn't dismiss. You shouldn't say, oh, this is nothing. But at the same time, you shouldn't be afraid, right? The goal here is to make sure that people take precautions and make sure that we are encouraging not only our local healthcare systems and, to be prepared and doing everything we can, but also organizations. So we had a conference call today with one of the homeless shelters that we work with, and, looking at, all right, what is our response going to be? Doing that in advance is so important, because you don't want to be 30 days down the road and saying, what are we going to do now? Right. So the goal of this is, if you're scared, back off. If you think it's nothing, move forward. Right. We want to get people in that range where they're taking this seriously. They're not scared, but they're taking it seriously.
Well, the place I want people to get to is where Hong Kong got to, right? So they kept a resident cultural memory of SARS. And what happened there is they found, just in Financial Times, I think yesterday, they showed that normal seasonal flu, types A and B, went to 0 a month earlier than normal, because they did the things you should do. Everybody's wearing a mask, which of course helps prevent the people who are sick from telegraphing it to other people. People are being very conscious about not touching surfaces and then their face. They're doing daily cleanings. So they crushed it, right? And they actually have linear growth in cases, which is very, very, doable. The thing that I'm worried about, and that I've been talking to our people about, is what happens if you let it go exponential on you and you overwhelm your hospital system, so that even normal comorbidities become actual morbidities, right? So we don't want to overwhelm the hospital system. And that's where, if people are far enough back here where they're still coughing in public and not being aware, you're not going to stop an R0, 4 to 7, somewhere in there, right?
100%.
You've got to bring your awareness up.
Agree.
Yeah,
Yeah, because what you just said, a month. Now you hear that, and if you're not thinking exponential growth, you're thinking, well, a month is a month, right? But I always have a calculator. So let's say you take a 16% daily growth rate, and you take it out for a month, you've got an 85-fold increase in the number of cases. This is the growth rate that we are at right now, right? So what you're talking about in terms of containment is really something that could have a profound effect on the number of cases that we see. So yeah, containment is extremely important. I hesitate to say that it is a silver bullet, because we've already got hundreds of individual nodes that are distributed across the world. So if you think about this virus, it originated in a single node. So now that we've got hundreds of them, the genie's kind of out of the bottle. So the ability to contain it, to lock it down, to make things, quote, airtight, and I won't even mention the CNBC commentator, former CNBC commentator, who made that reckless comment. To talk about things being airtight, there's no ability for that. But we can slow it down with containment efforts, and we can also, and it's really important to think about this, we've got about a 30-day window until that case growth goes up to the point where hospital systems are going to start facing stresses and are going to have to make decisions about, how do we triage the SARS-CoV-2 cases from the rest of the hospital. One of the lessons that we've learned from other countries is that when you do have viruses like this, they are contracted from others, and so very often they are contracted in a healthcare setting, because that's where people go. And so if you believe that you have SARS, when I say SARS, the technical name of that virus is SARS-CoV-2. That's what we have now. People refer to it as COVID-19, but the disease that it creates is called COVID-19. The actual virus is called SARS-CoV. SARS standing for severe acute respiratory syndrome. that's what the risk is, and that's what we're looking at. But when you look at other countries that have had similar experiences with these pandemics or epidemics of various kinds, one of the things that people shouldn't do is go straight to the hospital if they suspect that they have a case. If you have something that the hospital can do, and with a viral respiratory condition, that usually doesn't happen until you've got a very high fever or you've got respiratory distress. You shouldn't be going to the emergency room. The goal in that case is self-care, self-report, so that people know that you're there. So if there needs to be testing, and if we have the equipment and reagents to test, which is a problem because right now we've got some problems in terms of actually getting PCR testing for people. But if they can test, that's important. And then basically self-quarantine, so that you are keeping yourself away from other people in crowds and transmission. So self-care, self-report, self-quarantine is very important, because a viral pneumonia or a viral respiratory condition, isn't something that there's like, okay, we're going to give you this drug, we're going to do this, and this is how we cure you. What you do with that when you get into the hospital is basically trying to manage that while, and reduce symptoms and reduce the severity of symptoms and make sure people can breathe and so forth. So again, people shouldn't be going straight to the emergency room, because if they don't have a case, and there are cases, in that hospital, and I suspect that Italy being kind of a close-knit country, one of the things that we're getting is a lot of transmission really close. You can amplify transmission pretty quick if everyone's headed to the emergency room, right? And you can also overwhelm the healthcare system. So those are things to think about. It's really important that we get information out so people know what to do, how to respond. Again, if you've got high fever, if you're having trouble breathing, that's an important time that you want intervention. But otherwise, we don't have drugs that will just knock this out. It's not like you have strep and somebody can just give you antibiotics and then test you, a few days later after your course is done and make sure that it's cleared, right? That's not the situation we're in.
Yeah. So, we were talking, a lot of what we focused on here is just how much and how profoundly this is going to change human behavior, right? So we're already seeing that once we get the quarantines, people's perceptions shift. This has already done a lot to rotate people's thinking around this. And I know the idea is that 97% of people don't die from this, but there's actually another few percent in there where my PhD is in pathology. So looking at the early autopsies and early case reports, there are a bunch of people, they're going to be living a life with lung damage afterwards, because their lungs they survived, but now their lungs got hit so hard, they're actually scarred with fibrotic tissue, and it's a real issue. So this is, I think it's appropriate for people to be concerned. I think it's appropriate for people to go into social isolation and quarantine, because for the common good, we want to make sure we don't saturate our hospital systems to the past point of capacity. And privately, at my age, I'm thinking, you tell me I have a 2% chance of dying. I'd like to avoid that if I could. And so that would be a goal of mine. So I find my behavior changing already. And so what I want to ask about, though, is when we look at the markets and everything was priced to perfection, and you were so kind not to mention the former CNBC commentator. So there was somebody else famous.
I don't think that investors have a really good concept of exponential growth, except when it comes to their favorite glamour stocks, right? They don't have a concept of exponential growth and what it means for risk aversion. So let me create this little wall I will feel much better about it, and we'll see how it goes. But what I see happening in the financial markets is basically a market that was priced for zero risk based on years and years and years of Fed-induced yield-seeking speculation. We learned nothing from the mortgage bubble. We learned nothing from the global financial crisis. Central bankers have learned nothing from the data, because if they did, they would know that the relationship between monetary policy actions, take any of them, whether it's QE, whether it's the level of interest rates, whether it's the level of the Fed funds and so forth, the correlation of those things with actual real economic activity is dismal. The effect sizes are dismal. You don't have huge effect sizes. Most of an economic recovery is frankly mean reversion. You take the output gap that occurred at the recession low, and you cut it down by about 8% per quarter. And if you look at the way that this economic expansion went, or if you look at where every other economic expansion after a recession in the U.S. has gone, it has followed that same mean reverting trajectory. So I'm not convinced that the Federal Reserve did anything other than to amplify speculation. So now you've got, after years and years of driving interest rates down and driving stock valuations up, and if you think stocks are cheap relative to interest rates, you don't realize that higher valuations are associated with lower prospective returns, and that by the time we got into mid-February, the prospective return on stocks, based on the measures that we find best correlated with subsequent returns, the prospective 10 to 12-year returns on stocks were negative by mid-February. So now you've got very low risk premium, and you can see all of my charts on these sorts of things. Go to my Twitter feed, Hussman JP. But when you came into mid-February, you had a market that was priced for zero risk, and now we've had an episode of that meeting risk aversion. And risk aversion, in my view, is in its early stages. People look at this decline and they're saying, "Where's the bottom?" Oh, I don't think we've hit the bottom. If you look at a typical bear market, yes, you get certain interim lows. You get spike lows, and then you get hard rallies up. You get these, what I call fast, furious, prone to failure rallies. And some of them off of nice, steep losses can last for 10 weeks, 12 weeks. They can last a good long time, and then they fail again. But I don't even think we're at a solid interim low for the first wave, because the first wave hasn't taken into account the kinds of economic disruptions we're seeing in supply chain and so forth. They're not seeing they're not taking into account the reduced mobility and people staying home from work and all of these things that we need to do to get past this health crisis, but in the meantime are going to affect the economy. So at some point, my sense is that people will have that daily, oh my gosh, oh my gosh, oh my gosh, when they're looking at this 20% increase, because they're surprised by it, because they haven't factored in exponential growth. And at the point where they do that, and the point where they actually take the full effect in, we may get something of a crescendo of initial selling that tries to selling effort, because as you know, every time somebody sells a share of stock, somebody's got to buy it, and that's a problem, because you don't just sell, somebody's got to buy it, and value guys like us aren't really interested in buying stocks unhedged, except at substantially lower valuations. So we may get there rather quickly. But once we do, and once that gets factored in, then yeah, you've got the prospect of having one of these more extended advances. But I think we're right at the early stages where a market that's been priced for zero risk is now meeting risk aversion. And as I wrote back in 2007, as I wrote back in 2000, as I wrote last week, a market plunge is nothing but a low risk premium being pushed higher, is nothing but a market that's priced for zero risk meeting risk aversion.
How did we get to this zero risk state? You know, I've been tracking it for a long time. I know you have as well. And Janet Yellen said, we'll never have another financial crisis in our lifetime, because that was how complacent it had become at that, wow, that didn't age well, did it? I think she said that just anyway. So but that's what I was recording in February, right? When we're making all-time new highs, it was the most dramatic moment of mispricing of risk that I think I've ever seen in my entire life, because I was reading the tea leaves completely differently from whoever was doing that buying. So in your mind, how did we get to such an extreme moment of risk aversion? Was it just that complete of a faith in the Fed, or what happened there?
Yeah, so the way that we got to low risk premia, right, and extreme valuations is this. So valuations, and I talk about this a lot in my comments. You know, valuations have an extraordinary ability to explain and to anticipate long-term returns. And when I talk about long-term returns, I typically talk about 10, 12 years. The reason I pick 12, which is a weird number, is if you look at misvaluation or deviations of valuations from their norm. The deviation of valuations from their norm this year is correlated pretty highly with the deviation next year, and so forth and so forth and so forth. And it takes about 12 years for that correlation profile to go down to zero, which means that 12 years is kind of the most reasonable time to expect mean reversion if you're looking at extreme misvaluation of the market. So you can tell a lot about where you are in the market cycle by looking at valuations. The problem is valuations aren't a timing tool, right? So what drives market fluctuations over shorter periods of the market cycle is whether people are inclined to speculate or whether they're inclined to risk aversion. And speculation is kind of interesting, because when people are inclined to speculate, they tend to be indiscriminate about it. And so, you know, one of the hallmarks of this period that we've come through is that people were chasing everything. They were chasing big cap stocks, small cap stocks, junk bonds, high quality bonds, treasuries, low, covenant light debt, and so forth. So they were chasing all these things, and that was basically an indication of speculation. So when people are inclined to speculate, and you can see that in those market internals, valuations can sometimes temporarily not matter, right? So you can be overvalued and get even more overvalued. Now, I'll tell you what my mistake was in recent years, and it was one that we had to adapt to. In other cycles across history, there was always a limit to that. There was always an extreme where you could say, "Oh no, there is such a thing as too stupid. There is such a thing as overdone." And when you saw certain syndromes that gave you that idea, that conveyed that signal, you could sell the market. You could go bearish, and the market would soon follow by a crash or a huge sell-off or something like that. Once interest rates hit zero, so did the IQ of Wall Street, apparently, because there was no limit, and my response to those limits turned out to be, profoundly unhelpful. And so back in 2017, late 2017, I basically abandoned that response and said, look, if we see internals positive, if we see people with that speculative bit in their teeth, we can be neutral, but we can't fight it with a bearish position. And so that's what we've been doing since then. I'm still classified as a perma bear because of my response in this cycle. People don't know how, that I was leveraged in the, much of the 1990s bull market, and that I've gone constructive after every bear market in 30 years, because this time was different. And it was different because once they dropped interest rates to zero, the novelty of that just removed speculative limits. People had this idea that there is no alternative. Tina, there is no alternative. I have to own stocks. I have to own risk assets, and the Fed has my back, right? And so that combined narrative, and it's all we've heard for years and years, that, oh no, the Fed has our back, the Fed has our back, the Fed has our back, has really encouraged this speculative bubble, and even worse, a massive issuance of lots of low-grade securities. Just like we saw in the mortgage bubble, we've seen it in this cycle in things like triple B debt and covenant light debt, which has very weak protections for the investor in the event of bankruptcy. We now see corporate debt at basically 60% of corporate revenues, which is the highest multiple that we've ever seen in history. So we've had a lot of expansion in debt, and we've also seen companies say, oh, well, interest rates are really low, and imagining that stocks are still priced at levels that have a high cost of capital. So companies use their earnings to buy back stocks, and so we've also leveraged the corporate structure up. So we have less equity and more debt in aggregate. This will be a problem down the road. I don't quite know when. My suspicion is that if we get into some economic distress, people will start thinking about this. You can see people starting to get an inkling of it in the past few days in terms of selling off the investment grade market and selling off some of the junk debt, but that may have a way to go. It's something that we have to watch, right? But basically what's happened is when people were in a speculative mood, easy money amplified that speculation. What people don't remember, because as Galbraith said, the financial memory is so short, right? What people don't remember is that when people moved to risk aversion, like they did in 2000, 2002, like they did in 2007 to 2009, easy money does not help the market. It does not support the market, because all of a sudden people actually factor in the possibility of capital loss. And in that environment, when people are risk averse, low interest rates don't do anything. Cheap money doesn't do anything, because risk-free money is a desirable asset rather than kind of this undesirable, inferior hot potato that I have to get rid of so I can get my hands on, stocks or Cub Light debt or something like that. So what happened is that people came to rely so much on the idea that the Fed could bail anything out, and we are observing a trigger of risk, let's say, that is not easily fixed by easy money. And so now people have to readjust that thinking.
And John, on that, so you've just laid out a great argument for why the market was so vulnerable to the type of black swan that's happening right now. If I ask you to put on your future vision goggles and prognosticate into the future from here, has this broken the decade-long bull market run that the markets have been on, and whether you think it has or not? What do you see going forward from here in terms of where you see the market headed? Is it permanently wounded? Are we going to drift lower from here? Are those imbalances you were mentioning now going to actually matter? Or do you see a period where we go into a recovery and retest the highs and get back to those days behind us now? What do you think?
So I think one of the challenges to this particular catalyst for risk aversion is that it doesn't have an easy narrative where it goes away, right? it's not something that I think people will suddenly just, I guess that was nothing. That was really what happened last, at the end of 2018. We had, the Federal Reserve had been tightening policy, and we had some weakness coming in globally. And, and so we got a sell-off. And then what happened was that Jay Powell and the Federal Reserve did a complete 180. They cut interest rates. They did everything they could to revive that narrative of just onward and upward. We're going to do everything to protect the markets and that sort of thing. And for a while, you can get a couple of can kicks out of that. I think the challenge we have here is that it's harder for people's psychology to go, oh, well, yeah, easy money will fix this, right? We're back to normal if we just get another discount rate cut. And historically, when you've had emergency rate cuts, which we just had, I don't know that people remember the emergency rate cut we got in early 2001 or the emergency rate cuts that we got in, during the 2007-2009 decline. But I can tell you, emergency rate cuts historically have not been good for the market because they're basically a signal that something's gone terribly wrong. And the Federal Reserve can't wait to try and fight the risk aversion that's coming in on that basis. So I think it's hard to see things just, coming back. I think the real question is, what does the time course of the completion of this cycle look like? If you followed my work, one of the things is that what I care about most is data and historical data and evidence. And if you look at the metrics that are best correlated, the valuation metrics that are best correlated with actual subsequent returns, during the last several weeks, during the last several weeks of the advance that we saw running into mid-February, we actually got to valuations that were beyond what we saw in 2000 and 1929. And on the basis of, say, a conventional portfolio, 60% invested in stocks, 30% in bonds, 10% in cash. If you take our projections, our 10-year projections or our 12-year projections of those returns, the expected return that we placed on a conventional portfolio went negative. And that's the first time in history it did that. We actually only got to about 0.3% in August 1929. So we've had this enormous increase in valuations. And what people may not be factoring in is that part of the reason interest rates are low is because growth is also low. Nominal growth is also low. People may not realize that S&P revenue growth has only averaged about 4% annually, nominally since 2000, over the last 2 decades. And so we've got low interest rates because we've got low growth. And the problem of that with valuations is if interest rates are low because growth is low, and you do a discounted cash flow valuation multiples shouldn't be above average. Right. They should also be normal. And that alone is enough to give you commensurately low expected returns via the lower growth rate. So what we've got right now is a situation where stock valuations got to a point where they were almost 3 times the historical norm. So I actually think, and I do want this to sink in, I actually do think that the U.S. equity market could drop between 50% and 2/3 of its value, so 65% from its highs over the completion of this cycle. Never does it in one fell swoop. So one of the things that we have to look at in the interim, just like in a bull market, is what is the condition of market internals? Are people in a risk-averse mood? Are people in a speculative mood? The worst declines that we see historically are in situations like we have right now, where you have extreme valuation coupled with risk aversion that's increasing. So that's where you get your, kind of vertical declines, unfortunately. And that's something that we've been writing about for some time. The best situation for investors is when you have a very strong improvement in valuations, basically because stock prices have dropped, and you get fresh uniformity in market internals. So in other words, people get that speculative bit back in their teeth. That's when you have really strong returns. In the middle, which is where we're going to be probably for a while, we're going to have still rich valuations, but periods where market internals improve. And so we'll get these sell-offs, and then we may get these periods where we get a little bit of constructive action, and those periods can be 19, 20% rallies. But then, they may melt later. So we're in a situation where we've got a lot of risk between here and a point where we would think of as reasonably valued. And in my view, a 2/3 decline actually only takes us to roughly historical norms on the most reliable valuation measures. I know that sounds crazy, but you asked the question, why did stocks lose 89% of their value during the Great Depression? Well, it's because they lost 2/3 of their value twice. The first decline was just a move to historically normal valuations, and that would have been enough had there not also been policy mistakes. What people feel extraordinary pain about is that second 2/3 loss, where you lost 2/3 of your money and then you lost 2/3 of that. And that's how you got an 89% decline in the Depression. But that was the result of a normal return to historically, pedestrian valuations, but then policy mistakes that made it worse. I'm not projecting policy mistakes. I don't rule them out, but I'm not projecting them. I think it's a reasonable thing to expect probably more downside than people are thinking about, because even if you look at the highest valuation that you ever saw at the end of a bull market, which was October 2002, even those valuations are half of what we saw in mid-February. So that's kind of a best case scenario. And the problem with the 2002 low is that it was breached both in terms of valuations and in terms of price in 2009. So we got to even lower levels 7 years later. So, we've got some room to go before people start talking about generational buying opportunities and things like that you hear on CNBC.
All right, great context, and I want to dig deeper into that in just a second. But very quickly, since the great financial crisis in 2008, 2009, the central banks have definitely become much more emboldened in intervening, and they've continued to do so over the past decade. They have really not responded yet to the current immediate drop in the markets. Surprising, at least from my perspective, given how they seem to be willing to intervene on the drop of a hat in the market when it was going up. They probably are working on something. Do you think that the policy response from the central banks and the administration, once it's announced, will be enough to make a difference here?
So one of the things that we've talked about, and we actually have some analysis on this. If you look at monetary policy and then our best measure of speculation versus risk aversion, which is the uniformity or divergence of market internals. Remember, if people are in a speculative mood, they're indiscriminate about it, and we can infer a signal from the behavior of thousands of individual stocks, industries, sectors, different types of securities like treasuries, low-grade debt, mid-grade debt, all kinds of things like that. If you see people, in a speculative mood, kind of everything goes up. If you see lots of divergences and ragged market action, you can infer that people are risk averse. And so here's an interesting thing. If you ask the question, all right, is easy money or are extraordinary monetary policies good for the market? The answer is it depends. And it depends on the state of investor psychology. If investors are in a speculative mood, then yeah. Oh yeah. If you've got uniformity in market action, then easy money, Fed cuts, zero interest rates, all that BS that has, again, very little correlation with what actual employment, output, all those real things that they should be thinking about, very little correlation with that. And again, most economic recoveries are largely mean reversion. This one has been too. The path has not been vastly different because of extraordinary policy, but the path of the financial markets has. Because when you have a speculative mood and you fuel it with all of this, fear of missing out, easy money, that sort of thing, if you have a speculative mood in place, then yeah, it can do some good. The problem is if you look at the 2000 to 2002 decline, if you look at the 2007, 2009 decline, if you look at emergency rate cuts, one of the things you'll find is that they don't help. And the reason why is because in those environments, cheap money is a desirable asset. It's not an inferior one. It doesn't make you say, oh, I got to go and do something about this. I'm getting no interest on this. Let me go into the stock market where I'm going to lose 10%, right? If you have that mentality of risk aversion, you're not going to do that. The only reason that cheap money will drive speculation, will amplify speculation, I should say, is if people have psychologically ruled out the capital loss part of that equation. And they start just thinking about comparing yields. Oh, well, the yield on, treasury bonds is this, but the yield on utilities is this, and the yield on REITs is this, and the yield on this stock is this. As long as you don't consider the possibility of capital losses, you will yield seek into everything, right? But that's dependent on a speculative mood. So the answer to whether easy money or zero interest rates or negative interest rates will help the market depends a lot on the condition of investor psychology. And that's not something that I can tell you is going to be the same, 3 months from now, 6 months from now. I suspect it's going to be the same 3 months from now. But I can't tell you what it's going to be, a year from now or so, because it changes. And usually, the measures that we use, when they shift, they typically shift somewhere between, for a period of somewhere between 30 weeks and as many as 80 weeks, as short as sometimes 7 weeks. And if you get a whipsaw, you can get a week or two. But those ones we try and avoid. But usually it's in the range of maybe once or 1.5 times a year that you'll see a shift in the risk perceptions of investors that would say, yeah, here's a period where easy money is likely to support the market, is likely to help it. And I know, I've got a lot of critics on the perma bear side because, I try and be extremely open about this. I made a mistake in this cycle by responding to those extremes that were reliable in other cycles, and by taking a bearish view based on, that on a historical basis, this is a very extreme syndrome that's usually been followed by very, very bad outcomes. We don't respond to those anymore if internals aren't negative as well. So what I'm saying here is I think a much broader statement, which is that if you have people in a risk-averse mood, which we gauge by divergences, People aren't speculating in everything. Not everything, all these ships aren't rising at the same time. If you see these divergences and you see the Fed acting, you might see a kind of an obligatory knee-jerk up move, but that strength should usually be used to your advantage in readjusting your risk and making sure you have less of it, especially if the market's richly valued. Once you get to cheaper valuations, if you start seeing measures of risk aversion going down, so implied volatilities are going down, corporate risk spreads are going down, junk yields are coming down relative to treasuries, other measures of risk aversion are coming down. And then you see, in the context of reasonable valuations, the Fed doing something intervention-wise. Yeah, it is likely to be a good signal for the market. So all of this is conditional. The thing that I fear is that people are so wrapped up in this idea that, Fed easing means stock prices go up, that's going to be the hook that leads them to disaster. And so, I get my share of haters, but trying to protect people from those bad assumptions with data is something I'm kind of committed to.
Good. Well, and I think that's a really responsible warning. So if I can repeat back in summary a little bit what you said, just want to see if I've understood correctly or not. But trying to make this practical for the people who are watching, and there's a number of people out there that have seen the market, lose 20% of its value, extremely quickly. Some might be horrified because they're looking at their retirement account, just getting a haircut. Some might be a little inspired because they, like you, saw the risks coming and have been maybe sitting on dry capital and are wondering when the time to deploy it is. But basically what I hear from you is saying, look, markets were so overvalued, leading up into mid-February that they could still fall a tremendous amount from here just to be back to historical valuation metrics. We have a situation now where we'd had the needle stuck on greed and FOMO for years. It's all of a sudden now shifting very quickly to greed. And therefore, if the Fed does deploy some rescue mechanisms, they may not work the way that they did in the past. Looking at, you talked about sort of waiting for certain indicators to stabilize, whether it's volatility to come down, whether it's credit spreads to close, whatnot. We're not seeing that yet in the market. So where I'm going with all this is, it sounds like what I'm hearing you saying is, hey, it's a time to be conservative and defensive still as an investor. It's not time to be speculative for sure. And it's probably, if you're looking for those generational buying opportunities, they're probably not here yet. Did I categorize your standpoint roughly accurately there?
Yeah, I think basically the way to think about it is we had a market that was priced for zero risk that is suddenly meeting risk aversion. And the problem is that again, on the basis of valuation measures that we find best correlated with subsequent returns. And you can see a ton of research on that I've published over time. And again, valuations are not a short-term indicator. They are very good in terms of giving us a sense of where long-term returns are. If you look at where prospective returns were in mid-February, the expected return on stocks on a 12-year horizon was negative, as it was on a 10-year horizon. What the decline that we've seen so far, well, at least at the point where the S&P 500 hit about the 2,800 level, that was about the level that our estimates of 10-year prospective S&P 500 nominal total returns hit zero, right? So 2,800, you weren't even 20% off the most, in my view, ridiculously speculative valuations in history. That's not a buying opportunity. That is a haircut from extremes. A buying opportunity is something that, as Ben Graham said, investment is an operation that is based on the expectation of a satisfactory long-term return at a reasonable, acceptable level of risk. Right now, 0 on equities for 10 years, and I do think that that's a reasonable expectation, and you can see a ton of my research on that. 0 is not my view of an investment operation. Now, if internals improve, there may be a speculative operation involved in saying, oh, well, internals have improved, they've got the bit in their teeth, maybe we're a little bit constructive with a safety net or something like that. But right now, at 2,800 on the S&P, we're looking, we've only improved prospective returns from about, negative 2.5% on a 10-year horizon to 0. Yeah. Even lowly treasury bonds yielding 0.6 here have a higher expected return than U.S. equities. That will change. It always has, and we've published charts that show how that menu's changed over time. But it's not an investment opportunity. Over the course of the cycle, we'll see improvements in valuations, and we'll see certain periods where those improvements are associated also with an improvement in the speculative mood, and so those would be kind of intermediate trading opportunities or something like that. We don't see that right now.
Okay, great. And I just wanted to underscore too that at that 2,800, which is getting us just down to or up from negative 12-year returns to 0 expected 12-year returns, that's also happening at a time where we're seeing huge disruption in global supply chains, huge evaporation of demand, such that oil this week was down at one point, I think about 30% at some point on Monday. So to your point about seeing, the underlying fundamentals improving that would support speculative, projections that stocks should go higher. We're not at that stage yet. As a matter of fact, we're kind of seeing the reverse happening in the global economy. So with that, John, I want to thank you so much for your time. I'm looking at the clock here, and I know this has been an incredibly busy day for you in the markets as the past number of days have. Thank you so much for taking the time here to share your expertise with us. I know you don't do many of these public appearances.
I don't. I actually did it. I actually did it because of the public health angle of this. I'm happy to talk about the markets, but I try to I try to just focus on the work and and share the research that way. But this is a really important topic, and both of you really thank you so much for being in I think the rational middle of this discussion, which is don't be scared but be prepared. Take this very seriously because it is serious, but also this isn't panic in the streets. This is let's try to do things that will shave even a month off of the life cycle of this thing, the reproductive life cycle of this thing, because that could be literally a shift in the number of cases by a factor of 80 to 100. So I think the last thing I want to say is, look at your local organizations. Make sure that they have good preparations in place. Not to be scared, but to be prepared, especially the healthcare systems, and know what to do if you come down with a fever or something like that. That self-care first, and then if it gets to the point where there's something that really needs acute care, that's the point where hospitals become important. But let's try and keep people from also overwhelming the healthcare system unnecessarily, because that's another job that is extremely important for society. And so we want to do as much as we can to make sure that healthcare workers can, and doctors and everyone who's in that field, is able to do that job, without being overwhelmed.
That's such an important point. I'm really appreciate you reinforcing that, John. That's what we've been trying to really get across too in the daily videos that Chris has been doing. Chris, I'm going to end with a couple of housekeeping points, but do you want to insert here and say anything else before we wrap up?
I just want to echo that last point that John brought forward, which is, one of the statements I've been using lately is, if the facts scare you, the problem isn't with the facts. This thing that we're going through is going to require a big adjustment process from everybody, and everybody's going to go through it. Our healthcare workers, your local authorities, your town councils. And so I've been working with a local hospital and the respiratory team to figure out how they can possibly manage this better, and working with my local town government as well to think about what the plans are. This is a time I think is going to call all of us to come out and participate as citizens. Part of my message is we can't wait for the CDC to come up with their silver bullet or some equivalent like that. Let the authorities do what they're doing at their level, and then we've got to do what we can do at our level, because this is all hands on deck. I believe this is something that's very rare. It's a once in 100-year sort of a pandemic, and it's really going to present enormous challenges. And I'm really encouraged that I think it's going to bring out the best in a lot of people too, and that we can rise to this, we can get there, but we've got to have the right information, we've got to have the right facts, and we have to know what we're doing. So, John, thank you very much for reinforcing those messages, because they're really very, very close to our hearts.
Hey, it's a pleasure to see you guys. I want to see you again in person before too long.
Yeah, play some guitar maybe.
Oh, that'd be fun.
That would be great.
There you go.
As we close here, for those that are watching on the coronavirus situation, if that's something that you want to continue tracking, most of you probably know this, but if you don't, Chris publishes a video every day at 6 o'clock Eastern on our YouTube channel, chrismartenson.com, DOTCOM, or you can just come to the Peak Prosperity website. We post them there soon after they're posted on YouTube. And John, I know that, given your strong focus on public health, there are several foundations that you're involved with and support. Are there any that for anybody watching that's interested in your work, where should they go to learn how to support or learn more about those foundations?
So I think for me, probably in terms of public things, I'm on the board of the National Autism Society of America. So if you're interested in supporting that work, they do a fantastic job. I'm actually going to mention the Annapolis Lighthouse, which is homeless prevention center that we work with, that does extraordinary work as well. So my own foundation is Hussman Foundation, and we've also got an institute on autism, Hussman Institute for Autism, HussmanAutism.org. But the ones that I really want people to support are, there are local organizations that are doing good work. The ones that are filling a need in your community, because those are the places where you'll make a difference that you can see, and I think there's something to that. If you want to support some of mine, go over to autismsociety.org or Lighthouse, AnnapolisLighthouse.org or something like that. But those are the places that I'd mention, and Hospice of the Chesapeake as well.
All right, great. Well, John, there's an old saying: "Don't meet your heroes because they'll inevitably disappoint you." But you are an exception to that rule. Chris and I had a chance to meet you in person a couple of years ago. And you're just such a great guy, John. I mean, you're clearly just such a good guy, but brilliant mind on the markets, molecular geneticist. You are a philanthropist, and you play a mean guitar, as Chris referenced earlier. Just a Renaissance man. We're so pleased and honored to know you, and we're so grateful that you took time out of your busy day today to come share your expertise, both on the public health side and
Thank
the side.
Yeah, thank you guys so much.
All right. Well, John, we'll let you go. And for those watching, we've got another interview that we recorded today with Steen Jakobsen. And if you've got energy after watching this great hour-long discussion with John, we hope you go over and watch that one. But with that, thanks so much for watching. Thanks again, John.
Thanks.